Hello, welcome back. With the opportunity of introducing our tool today, myinvestorsheaven.com is where you can find it. I wanted to take a little bit of a fresh look at Alibaba, and in the meantime, also tell you a few things about the tool and answer some questions that I got. Now, the tool is a tool that I have been working on myself basically for months. I have been developing it on my own, and I'm using a third party data provider which is called Financial Modeling Prep. Now, this provider provides stock information about all sorts of exchanges, yet I found that the most accurate ones and the most complete ones, for the most part, are actually the US ones. And so, for the New York Stock Exchange, for instance, or the Nasdaq, you will find pretty much all the companies that you will be inquiring for the most part. I haven't had any issues. Now, when we're talking about other exchanges, I have found that the API actually provides information about quite a few of them, but in some situations, information may be limited or actually very limited. So, for instance, if you type BABA here, you will see that this is the New York Stock Exchange, BABA. Right below that is the Alibaba Group Holding Limited in Zitra, which is another exchange, obviously. I believe it's the German exchange. And over here, you'll see that this is in Europe, and this actually has all the data pretty much that the API provides. Yet if you take a look at, let's say, for instance, let me try something in Singapore, for example, in Euronext, some random company here, I haven't even tried that before. You can get some limited information here, and while you get the stock chart, some information will be limited because the company, the third-party API provides limited information. So I wanted to make sure that I'm very clear about this because the data that I'm getting, it's not my data, it's provided by the API, and some things may be limited. Yet in terms of the, in terms of the New York Stock Exchange, or pretty much all the US exchanges, I'm finding that the data is pretty good. So far, what I have analyzed looks to be pretty fair. And so, yeah, I wanted to make this very clear because people have been asking, and I don't want to, to give false promises or anything of that sort. I have been working on this tool for months, and I aim to make it better. And it's good if people like to use it, but I want to make sure that they know what they are getting for supporting our Patreon page. All right, so let's take a little bit of a look at Alibaba, and thanks to the people who have already joined, I have to say, and the people who are interested in joining the tool. So let's see what the tool can actually do here and how we can actually use it for analyzing Alibaba. I'm seeing today that it's down 1.78%, and if I take a look at the stock news module over here, you will see that news tend to be, in terms of Alibaba that is, tend to be a little bit generic here. There is not much in terms of what is going on with the company. Yet you can find some information, some specific information. So for example here, why Alibaba, other tech peers are sinking in Hong Kong today, and this is April 25th, as you see. And if I open this up, you will kind of see that the reason for that is, for the most part, COVID cases and zero COVID policy. We kind of know about these things. And generally speaking, I'd say the whole thing is all about the downturn that we have talked about in terms of the Chinese stocks. And we're kind of expecting a potential reversal at some point. I was already selected on Alibaba, I forgot about that. So yeah, and we kind of expect some potential reversal at some point, especially when there is an agreement between the US and China for auditing. Now, the social trends, you will see here that the company is trending quite some today. That is very interesting. But let's see how we can use our stock analysis tool actually first to see what kind of things we can deduce for the company. Now, as you see here, the P/E ratio of the company is at 25. And as I've talked about in the past, the P/E ratio is useful, but it's not the end-all be-all because earnings can be affected by all sorts of things and can be really adjusted by depreciation, amortization, and some other things that can allow for kind of stalling some expenses. And so this is why I prefer to use free cash flow, and this is what I generally recommend people to use. And this is why it's called the discounted cash flow model and not the discounted net income model, right? So, the price to free cash flow ratio is 12.9, which is absolutely amazing. I've made a video talking about how Alibaba is actually cheaper than Coca-Cola right now. And it's actually true. It's actually true for Alibaba. I made it for Facebook, actually, but it's actually true for Alibaba. And so I wanted to talk about this kind of very undervalued companies right now, which is I definitely think Facebook and Alibaba are. And yeah, I made a video about Coca-Cola and Facebook, and Coca-Cola is actually more expensive than Facebook and Alibaba right now. So I will link that video at the end of this video. So I think it's gonna be an interesting watch if you haven't watched that. But Alibaba's stock shares have been up 10% from 2017. That's a little bit of an increase, and it actually dilutes investors a little bit. Yet we do know, because Alibaba have actually already announced that they will be buying back shares. So we do know that this figure is going to get lower and better for us. Now, the free cash flow to total liabilities ratio is at 3.26, meaning that we would need about 3 years of last year's free cash flow to pay back all the total liabilities that the company has. And we can actually see that a little bit later in the financial statements, just to see how this number gets introduced here. And the 5-year revenue growth, you can see it with a very handy chart here that has been going upwards. The same thing with the net income growth, free cash flow growth, and total equity growth. Pretty much the company has been going upwards and upwards for all of these figures here. Now, the debt to equity ratio has been a little bit low pretty much here. I adjusted this a bit because it was initially using the total liabilities. I think I will be making a separate one for this. Right now I'm using the total debt here. And yeah, this is actually fairly low. So the current ratio is at 1.64, and this means that the company has more current assets than current liabilities, meaning that they have more short-term assets than short-term liabilities for the most part. It's like 12-month assets to 12-month obligations due to liabilities for the most part. The company could do with better returns for sure here. That's a little bit of a burden, definitely. But it's not paying any dividends, and the next thing that we want to be seeing, after it's been down like 65% in the last year, that's insane, we want to be taking a look at the financial statements. Now, the income statement of the company here, you will see that it has increasing revenues from 23 billion to 109 billion over here, and the net income has been increasing from 6 billion to 23 billion. So pretty nice and large increase here, and I have talked about it in previous videos in the past. The company's stock price used to be much higher back in 2017. It was about 180 bucks, and right now it has like 5 times the revenue over here, more than that, and like what 3-4 times the net income, and it's actually less than half what it was 5 years ago, which actually is easy to see how the company is super undervalued right now. Now the total liabilities, total assets, and total equity here, you can see the whole breakdown, and pretty much the total equity has grown like fourfold, from 46 billion to 163, almost 4 times growth here. Amazing again. And the cash flow statement also increasing from 6 billion here to 23 billion through the years. Company is still investing many billions, as you see here, acquisitions, and over here purchases of investments. Very interesting for the company. Cash from financing activities, very positive here as well, and keeps increasing. It has been a little bit lower than the previous year, and that's better, of course, because a positive value here basically means that the company is getting debt. Now, that's not necessarily a negative thing, because a company that's getting debt could definitely be a very good thing, because debt can be used to leverage operations, can be used to make more money. It's a good thing for companies as long as it can be serviced. And remember what we examined earlier? We did examine the total liabilities when compared to the free cash flow that the company made last year. And so the free cash flow that the company made last year was 29 billion about. And if you go back to our balance sheet, you will see that the total liabilities of the company, this is everything. The debt that the company has, the liabilities, the short-term liabilities, the long-term liabilities, pretty much everything that they have to fulfill in order to preserve their existence. And so this was 93 billion, 93.63. And yes, if you divide 93.63 to 28.7, this is what you're getting here in the company, in the stock analysis chart. The value that we got here was pretty much 3.26 years. We will need 3.26 of these years to pay back all the total liabilities, is what it means. Now, the last thing that I always want to be doing, of course, is taking a look at the stock evaluation tool, because it gives me a line in the sand where I need to be buying the company, at what price I need to be buying the company for. And so you will see that the company's revenues have been pretty awesome here, and I'll obviously go lower here just because I want to be sensible and pretty much a little bit, I'd say, conservative, not overconfident. Now, this is a 5-year discounted free cash flow model, and so it makes a little bit more sense to go a little bit higher. It's not like a 10-year where you would typically need to go lower. And the net income margin that I'm going to be using is almost the same every year for the company. This is a great thing to see. I'm going to go 20, 22, and 24. The free cash flow margin, again, almost the same every year. I'm going to go 100 here, 105, and 110. In different videos that I have made, I have used the different values for sure. And this is what you can do if you get access to this tool. You can use your own values pretty much. And so when I hit calculate, you will see that I'm getting a low of 214 using these estimates here, and a medium of 267, a high of 330, which is way more than our current price, pointing to a company that is a very worthwhile company to purchase right now, based on their current financials and based on these estimates, which are fairly fine and fairly normal, I would expect. I mean, I don't think these are far-fetched over here. I definitely think that the company can achieve that. So yeah, that's what I wanted to talk about. Kind of give you a little bit of a sense of how the tool works from scratch, and tell you a little bit more information about how it works. You can of course visit our Patreon page. There are links in the description box below if you are interested in the tool and you want to support the channel. And if you find any issues that I can help with, for sure I will be there to fix it. And yeah, I hope I'll see you inside. And thank you for watching this one. And in the meantime, take a look at this other video that I made earlier about Alibaba. And in this one, I'm discussing its balance sheet and how it compares to the previous years. Kind of what I talked in this video as well. I think it's very interesting to watch if you haven't. And thanks for watching this one again. I'll see you soon. Bye bye.